Excellent. Hey, welcome everybody. My name is AJ Brown. The company that I founded back in 2003 is called Trading Trainer. And since this is a Friendsgiving event, and this is an event that I just find so valuable to sit through all these various presentations, I decided to kind of change things up. Usually I talk about my premium selling program. But I wanted to share with you something, and you'll have to excuse me on this, but I threw this together because I've only taught this to my program participants. I've never done a presentation on this, and usually it takes me quite a few sessions in order to get this across to my program participants. So we're going to do a high level, but I wanted to share with you this VIX hedging trade. It's when fear plays, the dual vertical VIX play. And I want to explain this to you because this thing has been paying off for us. And I have to give kudos to where kudos are deserved. One of my coaches introduced this to me over 10 years ago, and we've been refining it over time. And now everybody in my program always has this VIX hedging play in place. So let me go through it. I've got a lot of live demo stuff to show you, but let me go through some of the background with you. And I hope you get a lot of this presentation. I don't really have much to sell to you today, so I just want you to sit back and see if you can pick up and learn this trade. So let's get into it right now. First of all, a couple of facts that I want to throw out there. A lot of uncertainty with what's happening in the world and even in, markets here in the US right this minute. But if you play it right, this stuff can set you up for months, if not years to come, especially if you're using some of the things that I'm very familiar with, which is, equity options. We're talking index ETF stock options, right? Remember that money is not created or destroyed, despite what the talking heads tell us on the TV or on the YouTube. You know, this many trillions of dollars disappear today. No, it didn't. It moves from one hand to another. That's the definition of a market, right? So the key is making sure you're on the correct side of that equation, that transaction. So let's talk about this VIX. I'm sure many of you are familiar with it, but let me give you a little different perspective on this thing. And let me bring up a quick chart on the VIX. This is how I look at the VIX, right? This is the VIX volatility index, right? And you can see I've got a couple of different lines here. This first dotted line is actually a linear regression line. Another name for that is just best fit trend line. The linear regression line is just mathematically calculated, right? And what I like to do when I'm calculating my linear regression line is go back to the beginning of the VIX back in the 1980s and go from that starting point to the present and find out just about where that mean is, where you would find that middle ground, right? And that's roughly at this point in time around $18.95, right? Because what the VIX is it's a measurement of confidence versus fear, you know, anxiety versus like stability, right? And that mean is kind of like the where we are over time. Again, if I look at since the beginning of the VIX, and again, I'll go to all the data out there, you can see that a lot of the times it's spent below that line, and then quite a bit of time it's spent above that line. And when it goes above that line, and I'll talk about this more, when it goes above that line, sometimes it goes pretty crazy above that line. Like, for instance, this was the 1987 market crash, right? Then we've got the dot-com boom and bust. We've got the 2008 crisis right here. We've got the pandemic stuff. We've got some of the shenanigans around tariff in the most recent. So when the markets are uncertain, when there's anxiety about what's going to happen in the future, the VIX shoots through the roof. And it's actually for you people who have some background in psychology. I mean, this is a perfect, you know, actual quantitative analysis of the human psyche, right? It tends that and maybe this is back from caveman times when we're just always ready for survival mechanism to kick in. We got to go get that woolly mammoth. When fear breaks out, I mean, the proverbial poop hits the fan and we go into panic mode. But we as humans are always on point. We're never that confident. And that's why you never see the VIX really go very low. It doesn't spike low like it spikes high, right? So here's the scoop. The VIX measures implied volatility, and it basically does so. And this is very simplified on the S&P 500 options market, right? And it represents the market's expectation of volatility over the next 30 days. So if you think about it, think about looking through the windshield of your car at the road ahead. Now, we have all sorts of things like, weather forecasts and all that stuff. But really, when we're looking ahead, we can only see so much ahead, especially if it's a nice, bright, sunny day, clear. If it's foggy or if it's nighttime, we can't see as far ahead. So you what do you expect, right? And you're not always right. In fact, the truth of the matter is oftentimes, like I said, we're ready for the worst, right? We've been taught since childhood to be, prepare for the worst case scenario, right? So we're always on point versus looking through the rear view mirror at where you've been, right? A lot of our technical indicators, when you're talking about like moving averages or moving average crossings or the MACD, these are lagging indicators. It's stuff that's happened in the past, and we're looking at patterns in the past, hoping to understand what might happen in the future. But the future often doesn't equal the past, and that kind of reconciliation in our heads is where we as traders can sometimes get confused, right? Well, the VIX is a measurement, right? It's often related to the fear index. The higher the VIX goes, the more anxiety we have about what potentially is happening in the future. Also, low VIXs signal confidence and complacency. High levels signal fear and uncertainty. So again, bringing back my actual chart of the VIX and bringing us back to, say, the last 6 months of the VIX, you can see around $26, I've got a horizontal line that I call the unfounded fear threshold, right? So, right, when people purchase, especially big market movers, folks with big, I'm talking pension fund, mutual fund, hedge fund, big, folks that can move the market. Most of us can't move the markets, but when these big money traders want to hedge their investments, they will buy options, right? Because options can be used as hedges. And what does that do? That drives the prices of options up, and that's what pushes the VIX up. So when people are afraid and they want to protect themselves, they want to insure themselves about the unexpected in the future, they will buy options, causing the VIX price to go up. And vice versa. When they feel very confident about what's going on in the markets, they may relinquish, they'll sell their options off, and we get a confidence level. So down here at $12, we rarely over time have ever gotten below $12. I think in the 30 years that I have been trading stocks and options, I've only seen the VIX go into single digits a handful of times, right? But most of the times, it's between this 12 and 26 zone that I've drawn on my chart. And a lot of times you'll see people hedging against, the unexpected and their anxiety without actually it's kind of like the reason why, a lot of us buy health and car insurance. Like a lot of us, maybe if we go for our annual physical, that's about it. But we buy that insurance, we buy that car insurance. Maybe we haven't had an accident in years or decades, but we still buy that car insurance and we still buy that health insurance for the potential unexpected. Now, when the VIX starts to trade above 26, that's why I call this the founded, unfounded fear threshold. It usually means when we're trading above 26 that there is something, going on that justifies the fear. And, for those of you that have been dabbling around with selling options premium, I mean, that's my bread and butter. That's what I've talked about at a lot of these previous presentations. Um, the scoop is that this is where we live. We love when there's a certain amount of fear that's unfounded because we'll sell those options at a higher price to people, right? And then as time goes by, those options wind up expiring at much smaller value because options are wasting assets. That's a whole nother topic. But that kind of gives you an idea of implied volatility, right? There's always a certain amount of anxiety that we all have, and that's why we buy insurance, and that's why investors, especially big money investors, like to buy options when they start to feel anxious about what might be happening in the future on the road ahead when we look through the windshield. All right, so now you got an idea of what this VIX is. Markets are driven by human emotion. Oh, yeah, we have to understand that fear moves much faster than confidence, right? Again, this is all about the human psyche, right? Fearful markets cause investors to seek protection, and that drives up option prices, and that ultimately drives up the VIX. Confidence builds slowly, so the VIX rarely drops as sharply as it spikes when there's anxiety. This asymmetry actually creates an opportunity for us option traders where the volatility tends to rise much faster than it falls. And some people are saying, gosh, you're starting to not speak my language. What about all this stuff about aren't options risky? And a lot of that, especially in our circles, comes from folks that are trading directionally, right? It means that they're looking for stock moves that are going to go up or down, and they decide to leverage options, right? And that's really just one way that options move, right? A lot of people are saying, well, I like to look for things when it looks like the stock is going to go up because I'm used to that. I'm used to stock trading, but now I'm going to turbocharge it with options. Well, just as we turbocharge it with options and we can make big wins, the reverse is true. If that trade goes against you, you can then have very big losses. But what I like about options and what got me interested in options back in the late 90s was that not only can you use options to make money when the market goes up, you can also make money when the market goes down, much easier than shorting a stock, right? Shorting a stock, you have to have a margin requirement. You have to, you know, do a short trade, maybe you have to pay interest to your broker to borrow that stock to short it, all that good stuff that comes along with shorting stock. With options, you can just buy put options, right? So you can make money when the market goes up, down, but you can also make money when the market goes sideways. And that's where kind of selling premium and those type of strategies come in. I like it. My bread and butter is making money on time passing by. Again, taking advantage of options because they're wasting assets. They have an expiration date. But there's also this component where you can make money when there's fear in the market, or also make money when there is confidence in the market. In fact, with options and the different combinations that you can do with multiple leg option strategies, and of course, with the fact that options are different depending on their strike price and their expiration date, I think mathematicians have found that instead of one or two ways to make money when the market goes up or when the market goes down, there's 27 different ways. So that's what I like about options. Instead of having a tool chest with just one or two tools in it, I've got a tool for every situation, right? So I actually think the opposite true. A lot of big money investors, I call them the market movers, they also know that options are not risky. They're actually hedges to risk. It just depends on how you use them, right? All right. Really quick, I always like to tell you guys a little bit about me because I know that some of you may not remember me or don't know anything about me. So really quick, I founded a company called Trading Trainer. They call me the world's most disciplined options trader. I actually think behind my back, they call me the laziest option trader. I like to think of myself as an efficient option trader. I like to make money in the options market with the fewest moves possible, the least amount of effort, and the least amount of lost sleep, right? I don't like to have trades where I go to bed white knuckling it or, have ups and downs. The last thing I need is kind of somebody of Italian descent is ups and downs. We're already emotional as it begins, right? I've been doing this since 1997. 5 days a week since 2002, we've published our daily insights for our trading trainer participants. A lot of really successful option traders have my 2005 ebook on their computer called The Seven Strategies of Successful Option Traders. A lot of successful option traders have my home study course on their back. This was published in 2008. I've been around for a while. I want to let you know that I'm a learner like most of you. I did a whole bunch of college that I never wound up using. I've got mechanical and electrical engineering degrees, but actually, when I graduated college, I decided to open up tattoo studios. I didn't even use my electrical or mechanical engineering degrees till much later in life. I've got a strong background in commercial business and investing. And in the last 15 years, I've really spent a lot of my time learning how to teach because one thing I noticed when I started learning how to options trade is a lot of these folks that I was learning from were very successful. They'd show me their portfolios. I could see that they were successful, but they just couldn't convey what was up here to me. And so I wanted to make sure if I was going to get into this teaching gig that I could teach, anybody and their brother. So just to give you my history, in 1990s, I lost really big. First of all, I spent 27 grand on seminars that first year. And back then in the 90s, they had WebEx, but it was just used in like the corporate world. I was doing it more in person. You'd go and you'd spend half a day on Saturday in a hotel conference room. And the next thing you know, you pay to be there all day Sunday, and then the next thing you know, you're on an airplane going to a destination for like 3 days. And I did all this stuff, spent 27 grand, more than I paid on my first engineering degree from the University of Virginia back in the day. And then in my actual trading, and it's a good thing at this point, I was working at Hewlett Packard and making pretty good money and not yet started a family or had a big mortgage payment or anything like that. I wound up giving $85,000 back to the markets making really stupid trades. And that was just in the first year. I've made a lot of stupid trades, especially in those first 5 to 10 years. I'd like you to write this down, by the way. This is a little tangent, but this is how to crack that code. Number one, stop chasing shiny objects. In other words, settle on one type of investing that works well, not just with what you think you want to do, but your real lifestyle. For me, when I did finally start getting into corporate America, I wasn't going to be able to do day trading, right? I had to do end of day trading. So I focused on end of day trading. I focused on options because of the flexibility. But you pick what's right for you and then stick with it. Learn it well because, everybody's going to be flashing stuff at you all the time. And, if you've got shiny object syndrome, you'll be bouncing here and here and you'll never become an expert at anything. So just focus on what makes sense and then learn it well. Number two, find a mentor who is currently doing exactly what you want to be doing. And most importantly, this was my big thing, and knows how to teach. Since then, I've learned that this is called guided discovery, and it's so much easier to learn from guided discovery than trial and error, and a lot less expensive. Number three, join an investment group. For gosh sakes, look over each other's shoulder and leverage each other's trade with pride. There's no proprietary when you're an investment group. If somebody is doing something and it's working for them, look over their shoulder and you do it too until you've internalized it, right? And finally, surround yourself with like-minded investors, right? I had a lot of folks, especially in my family, who were really negative on the idea of option trading. And, when I quit my job in 2005 at Hewlett Packard, never to look back, I've never had a JOB, which I think is an acronym for just over broke. I've never had a JOB since. I've been living off my investments. Now, mind you, I grew my portfolio from 1997 to 2005 to a critical mass that not only allowed me to live off of the winnings every year, but also have enough gains every year that I could then roll those gains and keep parlaying my portfolio. That's a key. Don't just throw everything to the wind and say, I'm going to be a trader and not have that critical mass in there. Learn how to do it on the side. That's my 2 cents for you. Because these 4 tips, it took me quite a few years. I wanted to shortcut that. It took me almost like 1997 to 2003. It took me quite a few years. I want you to be able to figure this out at the end of today's Friendsgiving event, that this is what you got to do. And that way it won't take you 7 years like it took me. Also know that one of my big passions is that I started a foundation in 2003 where I take historically underserved inner city kids off the street and I teach them how to invest. In 2003, I started with 9 kids out of a kind of a suburb of Denver called Aurora, not the nicest place, where, since then, a few of them have become professors at a community college. Yeah, it was a huge success. And we've been doing it we had to take a couple years off during the pandemic, but we've since moved to Chicago, working with the kids in the south side of Chicago. It's really one of my passions. It's why I keep doing this. Everything that we do at Trading Trainer, which is my company, all the profits go towards this and working in Chicago with these kids. I make money personally off of my own portfolio, not off of my education business. If you want to learn anything more about me, or I'm going to be talking about some indicators that I've created and they're free for you to download, please write this down. You can go to links.tt4.me. This is what it should look. I've got it on the slide there, but here's the actual website. You can follow me on all the different socials. I would love that because those algorithms on all those different socials like it when people start following or, liking the videos and things like that. Especially check out our YouTube channel. We've got a Friday morning show that we do called the AJ Brown Show that I think you'd like. We've got our free indicator suite. We've got a free workshop where we talk about premium selling. We've got a program you can be part of. We've got coaching. We've got Trading Trainer. We've got all sorts of other stuff that you can check out. So this links.tt4.me. TT stands for Trading Trainer. Links.tt4.me. You might want to write that down. Again, lots of free stuff there that you can get a hold of. Okay, back to the VIX stuff. Let's get serious. The VIX hedging strategy. So the core idea, we're going to pair 2 bull vertical spreads. One's a debit, one's a credit on the VIX. So you can kind of see, let me see if I can pull out my magic marker. Yes, I can. You've got one spread here. This is how they look. So, they go to max profit if you're above the strike prices, and they go to min profit if you're below the strike prices. And then we've got another one here. And the key is one's a credit spread and one's a debit spread. That means it gives you a credit up front. And then you want, in theory, you want it to expire worthless. And then the other one is a debit spread. You buy it for an amount and you want it to go to max value. And when we purchase things, we enter these things simultaneously. And usually the expiration date we choose is about 2 to 5 weeks out. And this aligns with those short-term volatility cycles. And when we pick these 2 spreads, the idea is to get the price of the debit spread to just about equal the price of the credit spread. I actually like to see if I can get the credit spread to be a penny or 2 greater than the debit spread, and that way it'll pay for the commissions. So when you combine these things here, you can kind of see it in this picture, but maybe I should show you again in the actual, let's come over here to an actual, there you go. This is an actual trade that's going on right now. So imagine this whole VIX thing I said. Remember we said that if the VIX goes down, it means that we're extra confident. And I showed you that picture over time since the beginning of the VIX. And if you remember anything about that picture or anything about humans, is we just get so confident. We never get extremely confident. Remember, I said I've rarely seen anything below 12, and I can count on one hand the number of times I've seen the VIX at single digits, the periods of times that we've been at single digits. We just don't get that confident. What we do is we pick those two spreads in order to offset their costs, and then we bracket where the current VIX price is. So you might have to move some strike prices up or strike prices down, again, trying to balance the VIX debit and credit spread so that they balance themselves off. If anything, error to the side of the credit spread being more so that you can pay for those commissions. So most of the time when the VIX is just fine, when there's no insanity going on in the market, guess what happens to this trade? It pretty much just expires breaking even. That's why it's called a hedging trade. But when the proverbial poop hits the fan, and that's been happening a lot recently. In fact, it happened at the last expiration, which was October 17th. When the poop hits the fan, the VIX spread it goes to max profit, right? And so if you think about it, if we're only really, getting a credit or paying, a couple of pennies for this thing, and then this thing goes to over $1, we make something like 400, 500% ROI, depending on how you're calculating it. In fact, I've got my last VIX trade up here. It may, depending on how you guys read trades, 11 cents for the debit spread, 12 cents for the credit spread. Remember, I love for these things. And again, if normal times happen, it expires worthless, and you wind up, breaking even or getting that little extra bit of credit to pay for the commissions of this whole things, and you just keep cycling this trade on. But in the case of October 17th, let me show you what happened in the VIX on October 17th. This was one of those things where President Trump decided to tweet about China not getting a trade deal with us. I don't know if you remember that, but it shot investor, confidence into the ground. Fear and anxiety took over. And all I had to do was get above, I believe it was $21, $22. And so I wound up that morning when I was seeing the VIX trading up above my founded, unfounded fear threshold line, deciding to go ahead and close that down early, which was fine. You can let it go to expiration, or if it goes to max profit and you don't have to wait to expiration, you can close the trade early. Just closed that trade early and made full profit. And what's beautiful about this VIX trade, right? And you can see the way that, especially right now, and this is why I'm talking about it during this Friendsgiving event. What's beautiful about this VIX trade is, you put, right now I'm putting close to anywhere between 10 to 20. It's maybe right now between about 15 to 20% of my portfolio into the VIX trade every cycle, right? Because when your other trades, when things like this happen, no matter what strategies you're using, a lot of your other trades become compromised, and you're like, oh my gosh, out of nowhere, somebody put something on X or somebody put something on Truth Social, and my whole portfolio, even though I've been analyzing patterns, this is a new pattern. This is a shock out of nowhere, and it's really giving me agita in my stomach. It's making me agitated. Uh, this is where the VIX hedging trade compensates for a lot of your other positions that temporarily, and depending on your emotions, go out of whack. So let's talk about it more. Um, Timing this thing. So I like to time this when the market, when not just market bottoms, but the VIX bottoms. And I use something called the fast MACD. And again, I can't take any just like for the strategy, my coach introduced this to me 12 years ago. I can't take any acknowledgement over the fast MACD. This is something that the Appel father and son team came up with. Uh, 6, 19, and 3. The traditional MACD. Let's go ahead and take a look at that really quick. I'll pull it up. So when you've got your MACD indicator, it's typically the fast length is 12, the slow length is 26, the MACD length is 9, and it's usually an exponential moving average. For the fast MACD, Marvin and the Pell group over there at the MACD Institute, here it is. I've got it on. It's 6, 19, and 3 exponentials. And this is actually my free download of an indicator that you may want to go. You can go to that quick links and download that indicator, apply it. It's a Thinkorswim indicator. Um, it will actually put the MACD crossings in the form of arrows, and it has a little bit more granularity. If you ever, pay attention to my YouTube show, we talk about using the fast MACD calculated on, volatility rather than calculated historical volatility rather than calculated on closing prices. And this indicator allows you to get all granular with that. So you may want to download my indicator. If you don't, that's okay. So I like it when I get a bottom signal. Those light blue or cyan arrows you see there are bottom signals. And I'm an end of day trader. I think I explained that to you earlier. So after the market is closed, I look for those light blue indicators. And if I see one, then I'm going to either look the next day during the trading session to see if I can get a couple of follow-through rules met and actually place the trade, or even better, set up some conditional or contingent trades the morning of, and then just close your computer and let those either fill or not fill, depending on whether those couple of follow-through rules are met. Simple follow-through rules like is price above yesterday's close, things like that. And again, I don't want to get into too much granularity. I could be here for many sessions teaching all the specifics, but basically, look for some sort of bottom signal. If you've got your favorite bottom signal, then go for it. I'm just telling you what mine is, right? Fast MACD end of day signal with next day follow through is mine. So you go ahead and you find the bottom. This strategy activates when volatility appears poised for re-expansion after compression. And by getting in at the bottom, you avoid premature entry into ongoing sell-off. So again, how's my timing? End of day, I find my bottom signal. I'll look at the closing prices. I'll pick the two spreads, right? The debit spread and the credit spread based on their going prices. I want to match the prices and then compare the strike prices to make sure I'm bracketing where the VIX is right now. Then the next day, I'm going to ideally put the debit spread on first and then put the credit spread on after it. And then once those trades are in place, I just let it go either to expiration or until, some sort of event, some tweet or something causes investors to go off the hook and my trade to go to max profit. And again, I keep a portion of my portfolio rolling in this trade every time because especially in the last 6 months, this trade has, profited for us 4 or 5 times, basically, paid for a year of gains in my premium selling strategies as well. So run this in parallel. It makes sense. Here's the expected outcomes. Most of the time, trades result in near break even or slightly modest gains. Again, I just try to cover my commissions. But during market panics, when implied volatility spikes, the trade pays off absolutely significantly. It acts as a hedge. In other words, it gains from the VIX position and it can offset losses elsewhere in your portfolio. And it provides me peace of mind and a smoother portfolio performance during high stress events. And why does it work? Volatility is inherently mean reverting, but spikes sharply in crisis. Fear reactions create short-term mispricings and option premiums. This structure captures these short-lived surges while minimizing cost exposure. It's going to cost you pretty much nothing. This makes the trade an efficient portfolio hedge, not a speculative bet. So you could run your directional trades, you could run your premium selling trades, but put a portion into the VIX hedging trade. I'm just giving you what's working right now. Key takeaways. The VIX is a measure of market fear versus confidence. Our proprietary VIX hedge uses a dual vertical setup to exploit volatility behavior. Use some strategic timing. I like the fast MACD end of day signal with next day follow through. It enhances your edge and your consistency. And this trade provides built in safeguards for premium sellers, as well as directional traders, swing traders, trend reversal traders, earnings play traders during anxiety driven markets, right? All right, so let me take a second and ask you, how would you like to never miss one of these picks, whether it be one of my premium selling picks, whether it be my earnings picks? We've been doing a lot of swing trading recently. And of course, when we talk on this VIX hedging trade, minimize the amount of time you spend away from your loved ones. That's important to me. Even though I'm 52 years old, I have a 4-year-old toddler and she's my whole world. So I like to spend as much time, with her. And I've got quite a few hobbies. And so and I've got that uh, foundation these are my real passions. So the last thing I want to do is create another job that I left back in 2005 with Hewlett Packard out of this trading stuff, right? I want this to just make me money so I can do the stuff that's important to me and be with the people who are important to me. And most importantly, how would you like to have support whenever you need it? Because that's really what this should all be about. This whole trading endeavor that, you're learning about, you're getting every little tip you can about. It's all about saving time, and time, by the way, is that one asset that we can't get back. I just had another friend get really sick and he's on the verge of passing away. And it just reminds me that time is one of those things that you got to take advantage of in the present, because you're just not going to get it back. Creating clarity and getting the results, right? And in this case, you know, for investors and traders, the results should not just be, oh, that was a good learning movement, that was a good pat on the back. It should be cash results, right? That's what we're in it for. So, would it be okay if for the last, it looks like I've got just a few minutes here, if I take a couple of moments and tell you a little bit about the materials I have, the training I have, and the tools to see if they might be a right fit for you? Who is this for? My program is really for someone who doesn't want to pay for multiple data subscriptions and try to correlate all the information. They want everything they need in just one place. They don't want to miss any kind of opportunities. They want to spend more time doing other things. They don't want to be doing this alone and they want step-by-step instructions. In other words, it's someone who wants to get consistent and reliable results. Quick testimonial. This was Charlene. She's amazing. I got a chance to actually meet her live. She was a teacher for almost 30 years and she got sick, cancer. And she stuck on for as long as she could, but she got very weak. And ultimately, the way she describes it, she was ordered out of the classroom, and she still had 13 years left to qualify for her full, school teacher pension, her full retirement. She thought she was a goner, right? And she was actually at peace with it. She's a very spiritual person, and she was cool with that. But she She had a miraculous recovery. That kind of speaks to this whole discussion these days, no matter where you fall on the topic around healthcare. In this case, she had a recovery, but it drained all of her funds, right? All these medical procedures. She had no livable retirement coming in. She was not able to collect any sort of Social Security for 10 more years. She got interested in the stock market. The rest is history. She met me. Now she's traveling and doing all stuff. She actually sometimes works for us here at Trading Trainer. Um, she reads her daily table in our program. She finds the stocks that she's interested in. She follows the strategies. She uses it along with our other strategies to diversify her financial plan. She recently made 14% on a single trade just by spending about 15 minutes reading about the company, following the chart, and waiting for expiration on her stocks. So, if you just want consistent gains, if you want to learn about the VIX hedging trade more in detail so that you can keep your portfolio safe, all that good stuff, that's kind of what we do here. Let's see here. Okay, so let me just show you if you were to be interested in what we've got going on here. There we go. You get access to this web portal. Let's scroll on down here. We've got tutorials on how to do all the different option trading strategies, especially premium selling. We've got learning webinars. These are the webinars that we do once a month, and there's a lecture series. And what's really cool about them is that we have them going back. Let's see how far back we go. All the way 2011, 2010, when we started this program. Anko was talking about her program being a 15-year program. Our program has been around that long as well. And you can search this. I've often been told that our premium selling learning replays is one of the most extensive encyclopedias on options trading. So that's kind of cool that you have access to that. What else do you have access to? We have a weekly workshop. In fact, a lot of my folks keep re-upping, right? They keep doing the program. And again, I'm like, am I doing a bad job? Am I not teaching you these option strategies? Why do you keep coming back? And they're like, because during your workshops, and these are every Thursday, you take a symbol and an active symbol, a symbol that's very much current, and you plan out the trade for us. All we do is we watch either the live workshop or the replay and take the trade. Why would we give that up and do it all ourselves? You do it for us. So maybe there's something that has to be augmented in our program. But we've been doing our workshops for literally a decade. So every Thursday, and my thought process is repeat, repeat, repeat. Once you've seen us repeat the process of how to plan out and take the trade, you're going to do the same over time because it really is the same thing over and over. You just different symbol and you go through it's the same process. We've got screeners. In fact, we've got not only our main screener to find those symbols to do trades against, we also have a whole bunch of beta screeners that we've been developing over the years. We've got a very comprehensive options lookup tool. I've noticed that all the options lookup tools on the web have all become behind paywalls. Our options lookup tool actually, if you download any of our free indicators, you can get access to this options lookup tool. We have options data going back 4 years. So you can do all sorts of volatility analyses on that and everything. My favorite part about the program is this trading questions. Not only can you ask trading questions, but I want to actually be there because a lot of people say, hey, when it comes to options trading, how long does it take to learn all the strategies? Well, that's going to depend on you and how much you give to it. But a lot of people pick it up in 2 to 4 weeks. So then they say, well, then why would I want to stay with your program past 2 to 4 weeks? Well, one of the reasons is because I like to look over your shoulder because I think learning by doing is one of the best ways to figure this stuff out. And so I make it so that you can send me your trade plans and send me what you're going to do right through this trading questions. You can see you can add files, you can send me screenshots, and I will look over your shoulder and reply back to you and say, yeah, that's good, or you missed this, or, and I like to help you tweak your, and people love that, getting their trades vetted before they actually do it. So, if you take the video tutorials, you take the monthly live classes and their replays, the lecture series, you take your screeners, your planning tools. I didn't even talk about the planning tools, but we give you access to all of our software planning tools so that you know exactly step by step how to do each trade, because with flexibility, and that's what the options give you, the flexibility to trade just about any pattern out there. There comes complexity, but with planning tools, that complexity gets simplified. Weekly live workshops and their replays, the trade reviews. What is that all worth to you, right? That's a lot of stuff. But wait, I want to make sure that if you do our program, and our program is a full 6 months. Again, I don't think it's going to take you that long to pick it up, to pick up these different option trading strategies, but I want to be there when you actually start trading them, have the possibility for you to send them to me for review. And also, I want you to be part of our weekly workshops so that you can get that repetition, so that I can get you kicked off. So I want you to try our program for a full 6 months. And if at the end of the 6 months and you're doing everything that we do, right, and you're not making money, not only will I give you the money back from the program, I will double it, right? It's called double your money back guarantee. Also, our coaches, I want you to have a free session with them. Uh, they know when you tell them where you are right now and where you want to be at the end of the 6 months, they know how to help you navigate and come up with a 6 month plan to get where you want to be. Or if your plan is not as um, aggressive as it should be, you're kind of like under promising yourself, they'll call you on it. Or if it's over promising, if it's a little bit too aggressive, they'll be like, hey, get back grounded into the real world. This is what you can do. So I want you to have a 1 hour session with them. This is a bonus for this Friendsgiving event. So, okay, if we do the double your money back guarantee, we do the bonus strategy session. What's that all worth to you? If you go on our website, the price for this 6 month program is $597. And it's a flat fee, right? There's no other charges. I'm not going to put you on a subscription or something that goes up in price or anything like that. But for the Friendsgiving event, I do want to drop that price. I want to give you a discount of $100. So I'm going to drop the price just for you guys to $497. Here's how you do it. You go to optioninvesting.org/friendsgiving. Or if you want to just go through that quick links page, it's right here. It's the join the program, right? If you go to join the program, wait for it. I hope that link's working. There it is. And you say get started now. It may ask you for your email address. I'll just put aj@tradingtrainer.com. Same thing. Whether you go directly or you go through the quick links page, but you'll see that the price is $597. The key is to put in a promo code. So I'm going to write down this promo code for you, or actually I'm going to put it up on the screen. It's 100DISC, as in discount. 100DISC. I'm not sure if capitalization matters. I'm going to test it out just to make sure my programmers put it in there. Capital D, capital I, capital S, capital C. I used all capitals. Apply. Whew. I'm glad that didn't bomb out in front of you guys live. $497 is what this comes down to. So yeah, if you're interested in taking advantage of 6 months of options trading from me, including our VIX hedging trade, really getting down into the details, then I'd love to have you be part of our program at a discount, get those bonuses, the double your money back guarantee, and get the free session with our coach. And let's see, what is last but not least? Yeah, optioninvesting.org, Friendsgiving, same thing. 100 DISC. By the way, back on my, yeah, that works too. Back on my slide set, if there's any sort of questions, first of all, if you've got a mobile phone and can point it at the screen, I think this QR code brings you there as well. And if it's befuddling you how to get the discount, just call us. You can call us at 970-266-8146. Tell us you're from the Friendsgiving event, and we will process your order over the phone. We've got some nice people talking at the phone. But let's go back really quick. I have about, I think, 5 minutes, and I would like to make sure, again, we review that VIX hedging trade one more time. So, again, the VIX, it's a measurement of fear versus confidence. When the VIX goes up, fearful events are happening. When the VIX goes down, confidence is instilling in the market. You'll notice if we go back in time that the VIX only goes so far down. If I go over the last 10 years, for instance, the VIX back here between 2016 and 2017, we had a little bit of calm, but since then, uh, we had, well, this is the whole pandemic spike. Took all the way till 2022 from let's see, this is 2020. This was when the COVID spike happened. It took until 2022 to get us calm again. 2023, 2024. Lately, we've been having some big spikes as well. But you can see that we only ever get so confident. And when we get afraid, we tend to shoot it through the roof. So we apply this VIX hedging trade. Basically, we take a debit spread and we take a calendar spread. This would be typically our debit spread. Actually, in this case, this is our credit spread and this was our debit spread. And you want to pick it such that the prices are very close. If anything, error to the side of the credit being slightly more than the debit. And for most of the time, the VIX will stay in this middle section and they will expire such that they cancel themselves out, and you'll wind up with just that small amount of extra credit to help cover commissions, things like that. But what happens when the VIX spikes and goes high is that this thing pays off. And already this year it's paid off quite a few times. And when it pays off, when it goes up into this other level, well, that's when you really tend to offset. And these tend to correlate with events that make other trades in your portfolio, if not well protected, go against you. So this is a huge hedge. And a lot of times this pays even better than those other trades. We, as option traders, really like it when the VIX goes through the roof like that. So that's kind of the premise behind this. You pick those prices and then compare the strike prices and tweak left, tweak right so that you can center, your price around here. Maybe look back at your VIX up to the point. I'm going to come back to the more recent, maybe the last 3 months, or maybe even the last 6 months. Maybe for a more recent trade, I've been doing 14.15 or 13.14 on the low side, and then finding out the opposite spread up here, wherever it falls to balance out those prices. And like I said, every time the VIX shoots up, that's when you take your profits and run and be happy that you're making money on the scenarios when the market gets pretty fearful. I don't know if there's any questions, but that is the end of my presentation, and I do want to thank all of you for letting me share this with you. This is the first time I'm sharing it with folks outside of my program, so I hope you got some ideas.